Welcome everybody to the first session of the RPOA Virtual Free Real Estate Investor and Landlord Conference. This is our first of 12 monthly sessions featuring national speakers on some of the hottest topics in real estate investment, as well as other breakout sessions and featured speakers. So we have selected a format for this conference, which is hosted by Remo. We decided instead of using Zoom like everyone is used to, we've decided to use the Remo platform because it's going to provide all of you an opportunity to network in a more realistic fashion. And it also is going to enhance your experience in general. And once you get the hang of it, we really believe you're going to love it. So our featured speaker today is Paul Isely. And once he is done speaking and done with his presentation, we're going to invite you to hang out with us to network afterward, just like we would during an in-person conference. But also, let me give you some housekeeping here. If you have questions during Paul's presentation, put them in the Q&A. Don't put them in the chat. Put them in the Q&A. And if you see that other people have that same question that you have, you can vote on it so it goes to the top of the list. And after the presentation today, I'll be doing the Q&A with Paul, and I'll be reading from the questions that you guys submit. So please ask your questions in the Q&A function there, and vote on them so that the ones that everyone the questions that everyone has rise to the top. So anyway, I'd like to take this moment before we start to thank our sponsors, especially our main sponsor, Western Star Insurance. Thank you, Western Star Insurance. And thank you to our other sponsors, which include Compass Realty, Culver CPA Group, Noel Saluski Agency, Redevug Brummel Risk Management, and West Shore Property Management. Thank you guys for sponsoring this. We really appreciate it. And now it is my pleasure to introduce to you our featured speaker for this session. Dr. Paul Isely is currently the Associate Dean for Undergraduate Programs in the Seidman College of Business at Grand Valley State University. And every year, when he speaks at the RPOA's annual conference, he is the best attended of all of our featured speakers. Business leaders, real estate investors, and those who keep a close eye on economic indicators listen very carefully to what Dr. Isely has to say, because he brings a great deal of data, analysis, and integrity to the information that he is about to share with us today. And with that, I'm going to hand the floor over to Dr. Paul Isely. Paul, thank you.
Excellent. Thank you, Brian. It's exciting to be here again this year. It's interesting to do it this way, so we will have fun with doing this all virtually as opposed to being in a big room with a lot of people. So it's my job today to walk you through the economy. We'll talk some about the national economy, some about the Michigan economy, and some about the entire U.S. I mean, about here in West Michigan. So let's see here. I'm going to start with the obvious. The economy fell into a deep hole at an unprecedented speed in late March 2020. So what we do know is when I was talking to all of you last year, we were just starting to feel the beginnings of COVID, and we were wondering how big of an effect it was going to be on the overall economy. And the short answer was, at that time, we said, if it's still #1 in your news feed in 3 or 4 weeks, this is going to be one of a pretty deep recession. And lo and behold, not only was it #1 in your news feed in 3 or 4 weeks, but it was #1 in your news feed for the entire year. So we know that this was an amazing change that happened. I want to make sure you understand this. We have no historical comparison to what happened. Because we have no historical comparison, some of what I'm going to tell you is going to be best guess, and I want to be honest about that. But what we will do by the time we reach the end is we will give you markers to tell you if you're seeing these things, then you'll know what I'm telling you was probably right. If you're not seeing those things, then you know that what I'm telling you has been pushed out further in time. So I want to make sure that you know those things. All right. So the first thing that you need to be aware of is a virus and public health response, not a broken economy, is what we're talking about here. This is not 2007, 2008, 2009, 2010. It's not even 2001 or 1991 or 1982. This is an economy that was shut down because of a virus response. All right. I'm not going to argue whether that is what should have happened or should not have happened. That's not part of this. What we do want to do is talk through what this did to the economy, what it will continue to do to the economy, and how fast we'll move out, and then how that will affect some of the particular industries that many of you are interested in. So, what caused the fall? If you go back to just a few weeks after the conference last year, the vast majority of states were starting to create some restrictions on gatherings at restaurants and bars. And that really picked up speed. And by mid-March, that was really starting to become the norm across the United States. And then as we got into the last week and a half of the month, virtually every state had some level of a stay-at-home order, but they were all different. So for instance, only 20% of the states effectively listed construction as non-essential. Michigan was one of those. All right. In fact, what you need to know is that Michigan had, by an economic standard, the harshest shutdown in the entire United States, based on research that was relatively recently done at the Chicago Federal Reserve. So we know that the effects and the types of shutdowns that happened here in the state were among the most severe that we saw in the United States. And a lot of this had to do with what we saw going on in Detroit. All right, so we'll talk about that. And finally, we know that virtually every place that's gotten it under control has seen a second jump in cases, often starting with nightclubs or bars, but it could be anything that had mass gatherings at it. All right, so that's really what caused the fall. So we need to spend a few seconds and talk about the virus. So my preferred measure, even though it lags further behind, is hospitalizations. So in this graph, the orange are the US hospitalizations. So you can see that they were elevated in April, became elevated again over the summer. That's not really a second wave. Some people call it a second wave, but what it really was the virus moving across the country. And then the real second wave started in the fall. And you can see that number rise well above what we saw in April. All right. And then about the middle of January, things turned and we started to see those numbers begin to drop. This is very typical of virus surges, and it doesn't suggest that anything in particular has caused it. We do know that as we have these surges, people become more cautious. They follow masking rules and social distancing a little better, and it appears that and not actually inoculations are causing this change. But you can see Michigan had a different result. You can see we were really getting hammered in April, and we were getting hammered in April because of massive effect happening in the Detroit area here in Michigan. So it was Detroit was looking an awful lot like those videos that you were seeing in New York City, and we had to make some very drastic measures to keep that from overwhelming our healthcare system. But as a result, as we reached the end of May, you can see as we went through the summer, our hospitalizations stayed very, very low all summer. And this was really good for anybody in the Midwest, particularly here in Michigan, because we had such a wonderful summer. The temperatures were awesome. We didn't have a lot of rain. It was easy for people to go and eat outside. And there will be restaurants that make it through this summer because of the money they were able to make last summer. All right. Then it almost coincident with the change in temperature. So it's when I do studies on this, I can almost perfectly predict this wave by using temperatures. And you can see as those temperatures dropped and people were forced inside, that we saw this take off. And we saw our hospitalizations peak in the early January. The new cases peaked in the middle of November, and we're actually starting to come down a little bit as the new orders were coming into place in November. But you can see since that time, we have had a steady decrease, and those hospitalizations are almost down to the hospitalization numbers that we had over the summer. And in the United States, they're lagging behind us, but they've had a steep drop in the number of hospitalizations. And this is taking a lot of pressure off of our healthcare system. Just to narrow it down a little closer here to Kent County, you can see here's the summer, here's the winter surge, the fall surge. This bump here, that bump is Thanksgiving. So this is people going to Thanksgiving. This bump here is the holidays and New Year's. This surge was caused by that. This little bump right here was the reopening of schools across Michigan. And right here, we're just starting to see a little bit of an uptick. That's indicative of two things that are happening right now. We went back to allowing some restaurants to come into place and things like that, but we also have a new variant coming into play. And so we can see it's upping a little bit, but we haven't seen a big jump yet, and that's really good news because it probably means that we'll be able to keep those restaurants open for a longer period of time. All right, so what did all of this do to the economy? So here's the US economy. You can see that those service providing jobs dropped by about 15% across the United States. And then as we went through the spring and early summer, they started to come back. And then through the rest of the year, they pretty much were flat as we went across the last part of the year. And we're down about 7%. Goods producing, manufacturing things, you see we're down 12%. Came back very quickly in June and have drifted upward ever since. So this is what happened nationally. I want you to remember these numbers. Remember this 15% and remember this 12%. And now I'm going to click and show you Michigan. All right. Here's Michigan. Notice this is down 33% and this is down 25%. This was a massive shutdown in our economy in April. It's unbelievably steep and it came back pretty quickly though. So it took 2 months, but we went from 33% down in service providing jobs to about 10% down, and we've basically held that ever since. The goods producing, it also came back pretty quickly, and you'll notice that basically in Michigan, the goods producing and the service producing are behaving about the same, which is different than what we're seeing in the rest of the United States. And part of that is we have so much manufacturing here that the people who are working in manufacturing who still have jobs are able to go and spend those things on services. And so it's elevating our services a little bit more than what we would have otherwise because of that income coming into Michigan. So the story of this and what makes the United States different than the rest of the world, all right, despite memes that you see on Facebook, the US government reacted strongly, aggressively, and in a way that they've never responded before to a recession. And that sums up in one set of statements, massive government stimulus. All right. So let's think about this. This is disposable personal income and it's annualized. So this isn't how much things change each month. It's how much they would change if it were a full year that had this change. So just understand that. And you can see disposable income over time had been rising across the United States. Our population is getting bigger and people are paid a little bit more. Okay, this is income after taxes. And in fact, if I stretch this back to the beginning of the time series, basically all you'd see is this slow, steady upward flow of disposable income until you reach April of 2020. And then we see this massive spike in income, despite the fact that unemployment had gone to near 15%. Think about that. People's incomes jumped just as unemployment also jumped. What caused that? massive stimulus, $1,200 checks, $600 extra a week in unemployment benefits, PPP, other initiatives, and they dumped about $2 trillion into the economy. Think about this. The federal government normally spends about $4.5 trillion a year. They dumped $2 trillion into the economy. And you can see as a result, people's incomes remained elevated all year long. See this orange line? That takes the trend that we had going on before and just moves it all the way through the year. And you can see we stayed above it all year long. And here in December, you started to see it pop back up. This is December, even though this ends at 11. You see it pop back up. That's the beginning of those extra checks that started to come out at the end of the year. Disposable income was higher. Some people ask, well, isn't that all at the upper end of the income stream? No. The data that we have shows that even the checking accounts of people in the bottom 25% were elevated at the end of the year compared to where they were at the beginning of the year. All right. This resulted in substantial savings. So you can see on an annualized basis, personal savings has been about $1 trillion. All right. Look at this bump that happened in April. And look at this in December, personal savings. This is the amount of savings that people have is more than double what it was before we started. Why? Because that massive government stimulus went in. All right. This massive government stimulus went in and elevated people's incomes, but they had nothing to spend it on because they couldn't go out to eat. They couldn't go on vacations. And so lots and lots and lots of people saved it. And what we know from surveys is that in this third tranche that we're talking about now, more people believe they'll save it than saved it the first time. All right. So I put this one in just because I'm always asked about this question. And so I want to make sure that we address it. U6 is a broader measure of unemployment, and somebody someplace taught people about U6. Normally, when you hear unemployment numbers, you hear what's called the U3 number. And we just ask, did you work at least an hour last week or last month? All right. And if you did, you're employed. Did you look for work and not have a job? You're unemployed. U6 adds in people who are underemployed, meaning people who don't have as many hours as they want. It adds in people who have given up looking for work and things like that. So the number is elevated. So this is our last recession back in 2007, 8, 9. And you can see U6 became elevated and it stayed elevated, meaning above 11.7% for 72 months. All right. Because of the massive stimulus that was put in place. Look at this. U6 only stayed above 11.7% for 8 months this time. There's a ton of liquidity throwing around in the market. Okay, so what about manufacturing versus services? So what's going on there? So this is our index for Michigan, West Michigan in particular. And when I was talking to you last year, we were talking about a light recession happening in manufacturing. And you can see this. The blue is the short run trend. The orange is the long run trend. So the blue one is a 3-month moving average. The orange one is a 12-month moving average. So if the blue is below the orange, things are slowing down. If the blue is above the orange, things are speeding up. And what we can see here is at the beginning of the year, we had started to turn a corner on that light recession that was happening. And then we had the shutdowns. But look what's happened since summer. We've shot up and we've continued to go up in January. The measure was 57 for new orders in January. Why is that so massive? The average for the last 25 years is only 14. So we have a big increase in orders, and that big increase in orders is actually creating some supply chain problems. we actually are having firms have to keep more of their more things in stock in order to build things because they can't get enough stuff from China. They can't get enough stuff from other parts of the United States. And so that's actually putting a constraint on how much can be built. We're seeing input prices rise, and I'll talk a little bit more about that later. But in fact, this last month, input prices for manufacturers increased faster than at any point since 2009. All right, at any point since 2009. That is a big increase in prices. Lead times are at a record. We're seeing these lead times really stretch out because of how hot it is in the manufacturing sector and how crippled the supply chain is because of COVID restrictions on the flow of people and the flow of goods. All right. Whereas restaurants, that other part of the economy, so that indicative of service, they're still hurting and still hurting very badly. So here's that initial hit, and these are US numbers, and then we'll talk a little bit about Michigan. You can see this big drop in revenues, okay? And you can see that that's a 50% decline in revenues in April compared to the year before, all right? That's not tiny. And then they started to come back as we started to reopen. And as we went through the summer, restaurants were down about 10%, okay? And here in Michigan, that meant between 18 and 20% of local restaurants were closed. This is measured by looking at restaurants that at the beginning of March were taking credit cards, and they weren't taking credit cards anymore. So we didn't see any credit card receipts from them. And that's created by Womply. And so, but this is mostly local restaurants. These aren't the big chains. This really isn't giving you the Applebee's and the McDonald's of the world. It's those local restaurants. And we were seeing 18 to 20% closed. And then as we went into November, there was another set of shutdowns. And we can see that more than 30% of local restaurants closed, more than 60% of bars closed at that point. So we're just now starting to get data to tell us how many of those reopen. But it's really looking that at the local level, we're looking at 25% of those local restaurants won't reopen in Michigan, and probably more than that as we look at bars. So this is not small movements. This is a permanent change that we're seeing going on, and these will be effects that will be with us for a while. All right, and that's why we see this dichotomy as we talk to people across Michigan, that almost 50% of the business leaders that we interviewed or surveyed said they were going to be hiring at a rate of more than 3%. That's a big clip for hiring. But at the same time, we have 20% are talking about they're still going to be shrinking. So if you're servicing that hospitality industry, if you're in that hospitality industry, if you're dependent on large events, like this would have been in person, you aren't doing a lot of business right now. But a good chunk of the economy is still popping along pretty good. And we can see that here, where as we surveyed people, about 20% said that it would be past 2022 when they were back to pre-COVID levels. That's almost equivalent to what we're seeing with the shutdown in the service sector. Versus over here, nearly 40% who said that by the middle of this year, they'll already be back to pre-COVID levels. So there's really this story of haves and have-nots all the way across the economy. And this is why this stimulus, as it's being envisioned in this second tranche, is so important to think about who you give it to. If you give it to everybody, all these people over here really don't need a lot of stimulus. And a lot of that will go into service, into savings, and it will come back into the economy as soon as they feel safe. So we're really looking for a pop here in the second half of summer. We're really looking for a lot of that savings to break loose if the COVID trends that we see right now and the vaccination trends that we see right now continue into summer. The people will feel safe enough, They'll have lots of money in the savings accounts. Not everybody, but aggregately they will. And this will induce a lot of spending as we hit that second half of summer. So what we see is the restaurants that make it there are going to do a pretty good job and have a lot of business likely, right? We're also starting to hear a lot of stories about people seeing this as a great opportunity to start a restaurant, because people will be charging into restaurants. At least that's what we're starting to think right now as they hit summer. So we're seeing a lot more interest in starting a restaurant if people were at that point. All right. So where are we on housing? Interestingly enough, construction didn't miss a beat in any of this other than the places where it was shut down. So right now, the confidence level in housing, in construction, the confidence level in construction is running better or at a level equivalent to 1999. Think about that. Here in Michigan, construction is as optimistic as they were in 1999. And if you remember the Prince song, Party Like It's 1999, 1999 was an amazing year for the economy. We were running so super hot that it was hard to lose money. So under those constraints, what do we see happening? I want to give you a pre-COVID snapshot of what we were sort of seeing in Michigan. And this is Kent and Ottawa counties, but it really fits almost the entire state. You can see that we took a hit during the last recession. We've more than made up that hit, and we were continuing upward as we started into that COVID timeframe. So that housing value, think about it this way: if I had to spend $100 to buy a house in 2000, I'd need $150 in 2019. Okay, so we can see that there was plenty of growth that happened. We know a lot of you spent some time buying houses when they were here, and you've had capital appreciation since that time. All right. If we dial that down, you have to have a big enough area to dial it down. So I'm just looking at Kent County here. We see a lot of the same effect in Wayne County. I'm going to do the county I know more about, but realistically, we saw this across the state in any place. First, there was a question: were people abandoning downtowns? The answer was no. We continued to see price appreciation, even in downtown zip codes, even in major city. Okay. But we did see this movement to wanting to move out into the burbs. And that really drew up that price appreciation as we reached into the third quarter. That was just hardcore. That was just hardcore. What we saw here. Here in West Michigan, we continue to see multiple bidders on any house on the bottom half of the market. So there's a lot of movement there. So what's part of that? Part of it is family formation. Part of it's the youth that we have. So we still have a lot of young folks here in West Michigan. We still have a lot of young folks in Detroit. The rest of the state is more rural and a little bit older. Okay. So what we can see is that families have been growing. They've been growing faster than those single family units. And here in West Michigan, we basically made up the difference by accelerating multifamily units. What's interesting about this is as we go here into 2021, a lot of people are trying to move into the burbs to get away from COVID issues or to increase the size of what they have. And so at this point, we're a little mismatched, even though over this time frame, if you look at that rate of change, the increase in housing units was keeping up with the increase in families that were happening over that time frame. The gap could just as easily just be the fact that we overbuilt in the early 2000s. So the gap might not be as important as that rate of change. So here you can see we weren't keeping up, and you saw those house prices appreciate very, very quickly. Here we're keeping up, but we're keeping up using multifamily. We're not keeping up with single family, right? So I want to remind you, this is not 2007. These are Michigan mortgages that are 90 days late. Look at this. This was the last recession in 2009. Look at this. This is 2007. This is 2009. Look where we are now. We're even below where we were going into the last recession. We're not seeing that that surge of people becoming late on their mortgages. But maybe this last number here isn't the second quarter. It's actually the fourth quarter of 2020. So this goes right up to the end of 2020. All right. You can see it's starting to trend up. And so the first thing you think in your brain is maybe we're just starting to see it. Maybe because of moratoriums and things like that, people were able to stay current. All right. These are people transitioning to 30 days late. So this is the percentage of people who are moving from being current on their mortgage to being 30 days late. Look at what happened in the fourth quarter. People there was enough money there and there was enough stimulus funds coming through that we saw a massive drop in people who were transitioning to 30 days late. This is not indicative that we're going to see a big surge in this is indicative of a surge that we're not going to see a surge in foreclosures coming forward. This is much different than what we saw last time. So that family wealth that's built up in the house, we don't expect that to be eroded. So they have more in their savings account. Their house is appreciating in value. We're not seeing a ton of foreclosures, particularly given the elevated unemployment rates. All right. So this is a much different story going on. So the story for the rest of the year is going to be interest rates and prices. All right. And I'm walking into this to tell you there's a lot of discussion about economists as to how big the price increases are going to be and whether we'll see much of an increase in interest rates. But there's very little argument among economists that we're going to see price pressures and interest rate pressures as we go through the year. Okay, so there's a lot of argument as to how big it's going to be, not a lot of argument that we're going to see it. All right, so why? First of all, I chose construction materials just so that we're dialing in on what all of you care about, but I could have just as easily chosen manufacturing or any other place that uses inputs. And what we can see here is that we're seeing a higher inflation rate year over year on construction materials than we've seen at any point since the end of the last recession. So if you're thinking about how fast those rates were, those prices, construction prices were going up in 2018, we're seeing more pressure now than we saw in 2018. That's a big deal. So what we know are people who have to buy stuff to build stuff are paying more for those things. In fact, the only place we've seen a decrease is aluminum, and a lot of that has to do with slowdown in aerospace and the fact that we have a lot of aluminum cans that were held at the beginning of the year and were dumped into the system late in the year. So just understand that. But we're seeing this big pop in construction costs. Okay. We have wages going up, and I'm going to pick on the bottom end because we certainly have a proposal for $15. It's more likely if they don't use budget reconciliation that will end up around $12. But there's a request for $15. I want you to see that since World War II, the average minimum wage has been $8.37 brought forward to current dollars. So it was, it wasn't $8 it wasn't $4 in 1947. It's $4 in 2020 dollars. So I've taken out all the inflation differences here. And you can see the peak that happened in the late 1960s was just barely above $12 an hour. And that basically since the mid 1980s, we've been cooking along right just south of $8 an hour on average. And before that time, we were cooking along right around at $10 per hour. So $15 an hour is way above what we'd be seeing historically. $12 an hour would be more indicative of what we were seeing in the 60s and the 70s. And quite frankly, the minimum wage in a large chunk of jobs are above $12 an hour now, and a lot of them are at $11 an hour. So a $12 bump probably is not going to change a lot of businesses. A $15 change could. A lot of the rules changes, like getting rid of tipped wages, which is in the bill, could have a bigger effect. But what we're seeing across Michigan, and actually across the United States, is a lack of workers available to do work. So people have left the labor force. We've seen two big groups leave the labor force. One is people close to retirement. They're like, you know, I'm close to retirement. The stock market's doing good. I'm not going to deal with any of this. I'm going to go home. I'm going to be safe. And I'm going to leave this to the younger people. So we saw a surge in early retirements. The other thing that we saw, what anecdotally we saw, but didn't show up as strongly in the data, were women leaving the workforce. All right. And what we saw, and what seems to be happening, we don't have the data yet, but what seems to be happening is it was actually women who were in the middle of the corporate ladder. The women on the bottom of the corporate ladder stayed or re-entered the labor force. The ones in the middle left. And that was often to handle childcare, extra dealing with parents, to deal with homeschooling. That fell disproportionately among women, and we saw them leave the market. So we saw people leave the market. We're not sure how many are going to come back. But what we do know is that because of elevated unemployment benefits, because of the need to feel safe, that some people aren't going to participate in the labor market. And here across West Michigan, our unemployment rate across West Michigan is below 4%, and in some counties is near 3%. When they want to find workers, they can't find it. They're raising their wages, trying to convince people to work, and they're having a hard time doing it. So we're already seeing that. So we're seeing input prices going up. We're seeing a lot of upward pressure on wages. And quite frankly, because of the decrease in number of young workers over the next 10 years, those wages are going to have a lot of tailwind to going higher. So those are going up. The last piece is the money supply. This because I left a zero on here, this doesn't look like a big bump, but look at this. This is billions of dollars. So we saw going from about 17 billion to about 17 trillion. I'm an economist. It's really hard to keep my trillions, billions, and millions completely separated. I'm sorry. So about 17 trillion to about 21 trillion. That's a lot of money that got dumped in. And what's happening right now is the Treasury is taking money that they basically have in the bank at the Federal Reserve and dumping that into the economy. This is a huge increase in the money supply, and that's keeping the short-term interest rates down. And so we can expect those short-term interest rates to stay down for the first part of this year. There'll be some pressure on the longer tail, but those short-term interest rates aren't moving anywhere in the near term. All right. So we'll start to see pressure on those longer-term rates as we reach the end of the year. But we have more money. So think about this. If I'm looking at baseball cards, and there's thousands of a particular baseball card versus two. If there's two, they're worth a lot of money. If I have thousands and thousands, it's not. There's so much money blowing around in the system that the value of those dollars goes down. And that creates inflation. So we're going to be paying more for workers. We're paying more for inputs. And there's a lot more money around. So the value of each of those dollars is less. We're seeing a lot of potential for inflation. So this isn't interest rates, this isn't prices, this is the risk level. So don't get confused here. I'm not calling for 6% interest rates or prices. I'm calling for a risk level this year. And you can see this risk level for 2021, 2022 is higher than it's been at any point since the early 1980s. All right. And if you remember the early 1980s, there was a lot of upward pressure on interest rates. Whether it happens on the interest rate side or happens on the price side will depend a lot on how the Federal Reserve reacts. So here's my thinking on that right now. Powell is up for the head of the Federal Reserve. Powell is up for reappointment. The president wants a hot economy. So we don't see the Federal Reserve tightening very fast because of that. In addition, the Federal Reserve has changed one of the metrics that they look at. So they're supposed to do two things: worry about inflation and worry about unemployment. What they've said in their documents is that the unemployment side, they're not going to look at overall employment like they have. They're going to look at minority unemployment. So they want to drive down that unemployment among African American and Hispanic workers. What that means is that they're going to let prices go a little bit higher than they would have before they react. So I think there'll be a more muted effect on interest rates than there is on prices. All right. Between the two, we see somewhere between 200 and 300 basis points of movement. All right. A basis point is 100 basis points is the effect of moving 1 percentage point. So if all of that ended up in inflation, we'd expect that inflation would be 2 to 3% higher than it was before. It's not all going to end up in inflation, but we do expect, and in fact, if I look at a survey of economists, whether it's from the Federal Reserve, whether it's from the Wall Street Journal, whether it's from Bloomberg, they're really looking at inflation being above 2.5% in almost every single piece for the second half of this year. So they're expecting 100 to 150 basis points being added to prices. They're also expecting those longer term interest rates to be higher at the end of the year. Realize there's not going to be a lot of movement in the first part of the year. We've seen a little upward movement, but because of some of the activity that's happening, we're not going to see a lot of it in the first half of the year. It's going to go up. It's going to go down. It might drift a little bit up. But by the end of the year, we expect that those interest rates will have increased up to 50 basis points in that longer term range that would affect mortgages and business investments. Now, there's some caveats to all of that, but those are the things that we're looking at right now. So let's get to our warnings. First of all, look at a few things, and I didn't add in one thing here that I'll add in at the very end. So don't watch unemployment. The press will get upset about it. It will go up, it'll go down. It's unimportant because the people who are unemployed for the vast majority of them are making pretty decent unemployment benefits. Right now, they're earning 300 above state. We expect it to be 400 above state. And that will bring them in somewhere around $13 an hour if they were working full-time at an hourly job. And then they still have the other government benefits that kick in around it. That's not great for somebody who was earning $75,000 a year, but it's not going to result in complete desolation and devastation for most people. Okay. Now there's people who can't get unemployment benefits. We need to look at those gaps. But as a whole, unemployment has much less of an importance now than it would be during a normal recession. Do watch hospitalizations. We're worried about those new variants. We're worried about, as we open up the economy, do we start to see a surge again? If you see that start to go up and go up in a way that starts to look uncontrolled, then things are going to be slow down again, and it's not going to be as hot at the end of the year as what I'm talking about right now. Okay, do look at passenger miles and border closures. That will tell us how much the economy is opening up. It'll tell us about fear. It will tell us about supply chains and whether they can work or not. So do look at those things. Do watch consumer expenditures. I never look at consumer expenditures because consumers are the last to know that something's happening. But in this case, because there's so much pent up savings, when they start to break loose that savings, it's really going to pop the economy. So what we're looking at right now is this first half of the year will be, slow growth. But the second half of the year, whether it's my estimates or estimates by other economists, we're looking at numbers that are talking in the 5% range in growth in the second half of this year. That's really fast growth as we look through the second half of the year. All right. Now, there's one that I didn't put in here, and it's gas prices, because it only became an issue in the last month. okay, or the last few weeks actually. The cool down in the freeze down in Texas and their problems with their power grid have shut in an awful lot of oil and an awful lot of gasoline production. Now, a lot of our gasoline is produced in Chicago area here in Michigan, but they may not be able to get the oil. The pipeline might not work as well, and they're going to be competing for people who want to buy this stuff down south. So it's going to raise gasoline prices much faster than we anticipated, and it's going to stay elevated for a while. So that could cause a drag on the economy, but it also will start conditioning people to think about inflation and increasing prices. And why that's important is one of the reasons prices don't go up as fast is because people aren't expecting it to. So there's sort of a drag on inflation because people aren't willing to pay more yet because they're not used to thinking about it that way. But this will start to condition people that way. It's going to increase those input prices earlier than we talked about. And I think it's going to put a lot more strain on those inflation pieces as we hit the second half of the year. We'll see. Gasoline prices were going to go up anyways because this recession had really affected a lot of the fracking here in the United States, and it shifted more power back to OPEC. And OPEC has been pretty restrained right now, which would have already increased our prices some. But this will increase it. All right. So right now we're in a race. We need enough people vaccinated that it keeps slowing things down and keeps the virus under control. Even if it doesn't keep you from getting COVID, virtually all of these pretty much help you not die, and that's important, or keep you out of the hospital, and that's important. If you think about it, if everybody got COVID, but nobody got sick enough to go to the hospital, chances are we wouldn't care very much about it. All right. So what we're looking at right now is the beginning of February, we're at about 8% of our population here in Michigan had their first dose. Right now, we're looking at that being as close as 18% as we exit February. It might be a little bit less. This cold snap here in the middle slowed us down. So we're actually falling off of this projection because we aren't able to inoculate people fast enough because they can't get to the centers, or we had to cancel clinics because of snowfalls and things like that. So the percentage of shots that we've used has started to drop here in Michigan. I'm expecting that we'll catch that up in the second half of the month. And that means that we'll be near 18% of the population inoculated, another 10 to 20%, depending on who you talk to, that have some level of natural immunity because they've had COVID. And that will be almost enough to keep that UK variant from running rampant. It still will be a challenge for our public health people, but it might not cause that exponential growth that we're worried about and may allow us to keep our economy open longer. So the faster we can inoculate people, the faster those new variants are less of a problem for us. In reality, think about this, 18% of the population actually means 24% of the population that can be inoculated because kids can't be inoculated yet. So that would be a pretty big number. And we expect that this will accelerate in March because we expect that at least 2 new vaccinations will be approved for March. Johnson & Johnson is going up for approval in the end of February. We expect Novavax to do so, and AstraZeneca might. They're having more problems internationally right now than they were before, so they might hold off. But I expect Novavax and Johnson & Johnson to be there. So the faster this happens, the more likely that summer looks good for us. All right. So where are we at? In the U.S. and Michigan, economies will likely reach pre-COVID levels in the second half of 2020 or early 2023. We have some economists calling for late 24, particularly for industrial areas that are highly impacted by travel. West Michigan is not. A lot of our travel is local. And in fact, a lot of the travel here in West Michigan saw a pickup because people didn't want to get on an airplane. So instead of getting on an airplane in O'Hare, they hopped in their car and drove up the lake. And so we saw that. I'm already hearing from Muskegon, Grand Haven, Holland, along our lakeshore that Airbnbs are starting to get scarce for this summer. So we're already seeing people wanting to spend that money and wanting to spend it in a way that allows them to travel and not have a lot of contact with other people, just in case. All right. So we're really expecting this. In fact, we expect Ottawa County may reach pre-COVID levels by the end of 2021. So some parts of West Michigan are hot enough right now that we may, particularly on employment levels, reach pre-COVID levels yet this year. That's all dependent on the virus being far enough under control as we hit July that people can travel, go out to eat, and do those sorts of things. So if you don't see that, those hospitalizations start to rise, then you can start to say, well, Dr. Isely was a little optimistic, and we need to push this out a little bit further. Okay, so that's where I was. I'm going to stop sharing my screen, and I believe that I'm going to be asked questions.
All right. Thank you, Paul. That was fantastic. Thanks for that presentation. And we have a lot of great questions for you, and I'll kind of go through the Q&A with you, but I just want to let our listeners and our audience know that if you do have questions, put them in the Q&A tab, and you can vote on the questions that seem to work for you, or that you want to, you're most interested in hearing answered. So I'll just kind of take it from the top here. The first question, let me scroll up here. So the first question, they keep moving around here, but the first question is, how much of the extra savings that people have right now is being applied to the stock market, bank accounts, home equity, that type of thing? I mean, where is that savings located?
Well, we're seeing it in many different places, but what we do know is it's going that there's an elevated level in savings accounts. So particularly those savings accounts, those checking accounts are seeing elevated levels. So for some of those upper income people, some of it's going into the stock market. But in reality, there's another measure that I look at, which is really the amount of money in savings accounts. And you can see that that is double what it was before we started. So you're seeing it being applied, and a lot of it's in a place that can be spent pretty quickly.
Great, thank you. So Todd asks, well, first of all, Todd Worsler says, great presentation, Paul.
Thank you.
Thank you. Is the recession that we have been expecting already done? So I don't remember if you talked about an expected recession last year, but has it already occurred, or have we just pushed that recession off to further out in the future?
Well, what we had was a light recession that we had going into last year that looked like it might not be very deep at all, that was then accented by this black swan event. Now, remember, as an economist, I can't predict black swan events. If I could, I wouldn't tell you. I'd bet a lot of money on it, and I'd retire, and you wouldn't see me presenting. But what happened is that black swan event took it and just put it on steroids and made it much deeper. So this resets the economy and really has us thinking an awful lot about the last half of the 2020s right now, when we were already expecting that recession might be a little more deep just based on cyclical patterns. Now, remember, having an economist predict 10 years out is sort of like asking a weather person whether it's going to rain next year on May 5th at 2 o'clock. They have a pretty good idea as to whether it's probable or not, but there's a lot of error in that forecast. So I think that that's done. I think that the recession that we started with that hit, when it's all said and done, and the people who call these things will say that this recession basically ended at the end of 2020. They might go as late as the end of the first quarter of 2021, but essentially the recession that we've been in is gone. There are a few areas of the country where it still exists, and think of those places where you have to have people gathering, whether it be Las Vegas, Disneyland, the Atlanta airport. All of those places are still struggling because of this, but we're already starting to see pickups in flight demand, And we expect that leisure demand will come back very, very quickly. That business demand will come back very slowly. So my short answer is the recession that we've been in is basically done. The recession that I was calling for last year got overtaken by this new recession that was a black swan recession. And we should be looking out a few years as to when that next one will happen.
And I'll just ask a follow-up on that. Do you think that all of this massive federal stimulus that is being poured into our economy is setting us up for the next recession? Or is that going to have its intended effect and keep our economy humming for quite a while?
Well, fiscal stimulus is about a 1 to 2 year increase in output. It doesn't have any juice past that point. One of the overly stereotypical differences between Republican and Democratic policies is Democrats are far more worried about that short-term effect, and Republicans are thinking about that long-term effect and not worrying about the short-term effect. We need to do both. And so what this will do is it will put higher interest rate pressures on the economy all the way through the 2020s. All right. Think about this. By the time the stimulus is done flowing, even if we only get $1 trillion out of this next one, as opposed to $1.9 trillion, the increase that we got in government spending is on the order of 1942. The last time we saw basically above 100% increase in government spending in a 1 year time period was World War II. All right. So we know that increase will put upward pressure on interest rates, upward pressure on prices, and will crowd out some private investment as we get to the last part of this decade. Why we were worried about the last part of this decade was that systemic debt of Social Security, Medicare, Medicaid, all of those things getting large enough that it would be hard for the U.S. to do stimulus policies when we hit that recession. All right. What this has done is probably has slightly moved forward when that starts to become a problem. All right. Economists don't worry a lot about transitory debt like this. They worry a lot about systemic debt. So this is transitory debt. It's more than we probably needed to take on. Now, if you're unemployed and having a hard time finding food, you now just hate Dr. Isely for saying that. I'm not saying the economy as a whole I'm not saying that there's individuals that aren't hurting. I'm saying the economy as a whole has had more than it needs. Okay. Did I answer the question?
Yes, thank you. Thank you. So the next question is regarding an article in the Economist where the authors showed that they were showing basically when nations will be returning to normal. And the article posits that China has already returned to normal by the end of 2020, but they project that the United States won't be back to normal until 2024. And I don't have a name here, but the person asking the question just wants to know what your thoughts on that are.
Yeah, I think China is pretty close to back. It's hard to tell because their data is so bad. If they aren't back, they will be back next year, given what they have. But understand, they still have a lot of restrained consumption going on in China because of COVID restrictions. So just understand that. Here in the United States, 2024 is a safety number. All right. Most economists believe that we'll be back faster than that, but some don't. So again, we have a distribution. I'm pretty optimistic. I think that it will be probably late 22, early 23, where the vast majority of the economy feels back to pre-COVID levels. It might be 2024 by the time all those little last pieces start coming together. And a lot of that will depend on whether people come back out of retirement. So if they retired because of COVID, and so they've left the labor force, do they now say, well, I'm just joking, I'm going to come back? What we do know is people who do that when they come back don't earn anywhere close to what they did when they left, because they don't get the same job they did when they left. So we'll see. I think that article is a little pessimistic, provided we see the stimulus that we think we're going to see with the Biden administration. And remember, we're still looking at, through budget reconciliation later this year, we expect infrastructure spending. So remember how fast our construction spending was already cooking along. Think about the US government kicking in $1 trillion to build roads and things on top of that. How long is it going to take you to find a contractor to get something done? And so I think the Economist was a little pessimistic, but understand that some economists do see 2024 as that time frame.
Well, and a follow-up to that question then, are there areas of this country or industries in this country, such as the airline industry, the cruise industry, the entertainment industry, that may need until 2024 to be able to bounce back?
Yeah, I think travel is where it's going to be the problem. I think a lot of venues, if you see what we're starting to see right now, particularly smaller venues, ones that don't need 10,000 people to make their money, if they're talking 100 or 200 people, it looks like the restrictions will move in such a way that those likely will be available. If you start looking at those concert bookings, so go out and look at your favorite bands and look at when they start talking about having events again. And you start to see a lot of things in August and September. So we know that the entertainment industry is really starting to think about the possibility of bringing back those small venue music events, those small venue theater events as they go into the second half of this year. So travel, that's going to be more problematic. Airline industry, going to be more problematic just because particularly Boeing has made some missteps, and we have a lot of the airlines can't afford to buy new airplanes. So that's going to be an issue, and that affects some places here in West Michigan. I think office furniture, which also affects Midwest, is going to be problematic because people are still trying to figure out what an office looks like 2 years from now. And so what we've started to see across the United States is that people are re-upping their commercial stuff, but then instead of having multi-year leases, they have 1-year leases. And I'm hearing about 6-month leases. They don't know how much space they're going to need and what type of furniture they're going to need in it. And that means there's going to be a pause on that. So I think if you have to hop into an airplane, it could be 2024 before we start to see a lot of that come back. And it may never come back because we're not going to see all of that business travel that used to happen. Some of it's going to get replaced by what we're doing now. Not all of it, because I guarantee you it won't take long for Salesforce to realize that their competitors sent a team on the ground and they got the bid. So they're going to need to start sending teams on the ground, and it's going to start to cascade as the first groups decide to do that. So yes, I think that there are particular areas, and I'd be looking at those that are really designed around supporting business events. So those convention centers and things that aren't designed around weddings and family events and those sorts of things will be the last to come out of this.
Great, thank you. I think, Paul, one of the questions that a lot of our real estate investor listeners and viewers today have is there going to be a dip in the pricing in the housing market or the real estate market? And David Gaddy here asked a question, where do you see single family home prices in West Michigan going in the next few years? Double-digit growth, or could we see higher or lower? I mean, what do you anticipate?
I think we're going to return to our upward trend across the region, particularly in the sub 350 range. We just have too many millennials here, and there just isn't enough single family for them to move into. So I see a lot of pressure on that side. What we see is another 5 to 10 years out that those people who've gotten into those single family homes this year, that's when they'll start thinking about laddering up, and that will start creating some pressure in 5 to 10 years on that next level. I'm hopeful about that because that's about the time I'll have to get out of mine, and mine's in that level. But that's what we're seeing right now. But we've also seen that people have a lot of extra cash. and they don't know where to put it. They're not making a lot of money on it. They're a little scared that the stock market's a little overvalued. So why not just put it into their house, upgrade their house, and do that sort of thing? So I think particularly here in West Michigan, particularly with the unemployment rate as low as it is, particularly with the fact, think about this, the money being paid in wages, okay, in compensation to workers here in Ottawa and Kent County went down by only 1%. All right. The hours went up, the wages went up over the course of the year compared to the beginning of the year to the end of the year. The total amount of wages being spent only dropped by 1%. Then you throw in this government stimulus, that's a huge amount of money running around here in West Michigan. And what I'm hearing right now is grandma and grandpa, mom and dad got money in the stimulus stuff. They're pooling that money and giving it to Joey and Jane to go and buy a house. And we're seeing that happen. And I think we're going to continue to see pretty good strength on the bottom of the market for the next 2 years. Now, if the Federal Reserve makes a decision to let prices ease and interest rate by forcing interest rates up, that could put an end to the party. But right now, what the Federal Reserve is telling us, what Janet Yellen wants, what the president wants, all three of them are looking at keeping those interest rates restrained through next summer. So I think we have at least 2 good summers running ahead of us.
Now, I know that real estate is location specific. We do, however, have a lot of people watching this today who are not just in Michigan, but in other states. Is the data you're referring to and your opinion on it also apply in general to other people around the country? Well,
I think what you have to do is you have to look at your industry mix where you're at. So every local area is a little different. So, we know a lake makes a difference. We these things we all know. You need to look at your local area. You need to be looking for employment growth. Is there employment growth? If there's not employment growth, you're not going to see pressure on your housing. You need to be looking at the rate of things being built. Is it outpacing the growth in people? Here in West Michigan, it's not. And you need to take a few seconds and look at your industry mix and say, is that industry mix one of those pieces like manufacturing that's coming out of the recession early? Or is it one of those things that may come out of the recession late? So there are plenty of places that were overheated before and people are leaving. So what we're seeing now, if you watch things like the U-Haul index, where U-Hauls end up and not where they're taken from, that we got a lot of people moving to Boise, Idaho. Why Boise, Idaho? Because they can telecommute. They're getting the heck out of California, where they can't buy a house for $750,000 that looks like anything, getting themselves to Boise and hopping on the internet and telecommuting to California. So we need to be looking at those places that have really good internet infrastructure, because those places are going to have those telecommuters leave wherever they're at and move to those locations. So I think there's a few places that may run faster and hotter, and a few places that may run slower. Here in West Michigan, we have good internet, we have growing workforce, we're not building faster than the number of people coming into the area. This is all good news for us.
Okay, and then just to put the icing on the cake here, you do not see, what I'm hearing you say is that you do not see a housing crash that I've heard other people predict.
Yeah, well, anything can happen. So remember, this is all forward looking, and forward looking is like driving down the road at 90 miles an hour using only your rearview mirror. Works pretty good while the road is straight. But what we're looking at right now is this is demographics driven and supply driven, not being driven by artificial government mandates to increase the number of loans to different groups of people. That set of dynamics in the late 1990s resulted in the no interest loan, resulted in that huge bubble that we saw in the 2006 timeframe. Okay, we're not seeing that right now. It's if we the markers that we're seeing, at least overall, suggest that this is being supported very well by the fact that we have enough people who are earning enough money who actually want to buy into this market. And that's not a bubble. That's good. You own something that someone else wants and can pay for. So that's what we're looking at right now.
Great. Going back to your slide on the number of people who are behind on their mortgage payments, we have a question here about forbearance and how that might be affecting your mortgage data.
Yeah. Well, the trick is that all of this gets messed up a little bit by some of these data. So you have to look at every single step of the data to try and determine, is this being affected by moratoriums? Is it being affected by forbearance? And the short answer is that we are seeing elevated foreclosures. I mean, they are going up a little bit, but they're not going up as fast as we would expect, and not as fast as we would expect, even given the programs there to keep it from happening. And when we talk to the bankers, we're not seeing them writing off loans. We're not seeing them say, "Hey, this is going to be unrecoverable." And so I think what we're seeing right now is that there are groups of people who are in trouble, but it's not most of the market. All right. So as a result, there's going to be people who just can't make it. They're in an industry that can't come back. They're being paid a lot less than they were before, or they have, and that's going to change things. So yes, there'll be elevated foreclosures, particularly as we start getting a little bit further into the year. But it's going to be nothing like we saw in 2006. And those opportunities that many of us took advantage of in 2006, 7, 8, 9, 10 are going to be much thinner this time around. Did I answer your question? Did I think I answered that question?
I think so. If I was listening to your presentation correctly, it seems that because people have so much more in savings right now, that is allowing them to pay for their mortgage, and that's why the massive amounts of people that we expected to fall behind have not fallen behind.
Right. It's really because of that massive government stimulus money. You have one family member working, one not working. The one who's not working for, think about this. In Michigan, 69% of the people collecting unemployment, 69, don't quote me on that. Somewhere above 60% of the people in Michigan are estimated to have earned more on unemployment benefits between April and July than they did before. That number will not be as high as we go through this year, but it is going to be a pretty sizable number. What we're seeing is a wealth transfer from people who are wealthier to people who are less wealthy, and they're using the unemployment benefits to do this.
Great. So we have a question that just a lot of people have voted on that has moved up to the top here from Brandon Bruckman, and it's kind of an extension of what we're talking about. Brandon says, "Thank you for presenting. Isn't the stimulus and massive money creation masking the problems homeowners and tenants are actually experiencing?"
Well, it could be. It could be. But remember, we've seen that unemployment rate drop. We've seen the salaries that people are getting who are still working going up. And so what's hiding behind here is we've dropped ourselves down to a relatively, what in the 1980s would have been a low unemployment rate. And what we're seeing are average wages and average weekly earnings starting to rise very quickly. And we expect that they'll accelerate as the year goes along. So I think that systemically, there's a good indication that a large chunk of people are actually going to end 2021 in a pretty good position. So I don't think it's really masking it. I think it's accelerating how fast we're moving out of it. Now, it could be masking it for several people. I mean, I know anecdotal evidence of somebody who's basically just coasting on unemployment benefits. They're They're using it to do different things. They're losing their skill sets while it's here. And when it runs out and that party's done, they're going to be in a worse case. There's going to be groups of people that are that. The press is going to be able to find people like that. For those of you who are renting, particularly on the very low income end of this, you're going to see that. And it may result, and the place we're most scared about this is people being able to stretch into a house that they actually can't afford to keep up. So I think that it's really more the purchase side we're more worried about, and the low end purchase side. I have had several realtors talk about very messy deals where lots of money is coming in. I think somebody called it a Frankenstein deal, where so much money was coming in from different places to bring them up to the point where they could purchase that house. And they're wondering that, given these people's skills level, once we come out of this all, will there be enough money there to maintain that house and that loan? That's all anecdotal evidence right now. We don't have strong evidence telling us how big of a problem that is. We do know that it's a problem in some jurisdictions, and you should be watching that. It could creep up and become a problem. I don't expect that it's going to be a big enough problem to derail the other people who are actually seeing their incomes rise.
Right, thank you. So the next question here is about softwood lumber. They say the price is up 112% in the last year, up 10% in just the last week. Mm-hmm. And Mike asked the question, will this ever go back down?
Well, everything that goes up comes down. I have a physics degree, and we know that if you throw something up, it comes down. And in economics, one of the things that forces that to happen is your price going up too high. Once your price goes up way too high, then people start looking at substitutes, and those substitutes start to eat into your market share of goods. Now, there's not a lot of great substitutes for lumber in a lot of the things that we're doing, but there are different markets to pull it from, and we do have a lot of trapped lumber north of the border, whether it be because of COVID restrictions and decreasing the speed with which it can come here, or whether it be from the trade war issues that we had going into the last few years. So I think if we can moderate some of that, it will take some of the heat off of this. But it's looking like a really good construction year. So that's going to mean that demand for lumber is still going to be growing, and that demand is going to really help push prices. We really haven't seen. We know that the quantity being sold has gone up as well as the price. So we know it's a demand side issue. And so as long as that's cooking along, it's going to be hard for us to see those prices retreat.
So how does that pencil out then? Because I'm working on a development project right now where the cost of lumber is definitely a factor, and it's increasing our costs. Mm-hmm. Are we going to see residential, multifamily, and just rental property prices or rents actually going up in 2 to 3 years because the cost of construction has gone up? So
yeah. I can say I don't know the answer to that. And it really depends on the trade-off between if people want to be in the single family market or the multifamily living. And there's some trade-offs that are happening in different markets with that. So I'm not quite sure where that is, but I know the cost of construction is increasing. And I do know that a lot of the things that are going on right now are trying to find ways to create cheaper housing so that people lower in the income stream can buy into a house. And both of these two things are becoming incompatible. And I don't know, because there's going to be some policy treatments on this come out of the Biden administration. And you need to be watching those, because one of their planks is to worry about low-income housing and how do you get people into houses. And we see every time that we've tried to do that, that it's in the end backfired. At least every case that I know of. There may be cases that it's worked. So we do know that we're going to try that again. We do know at least that that's one of the planks that President Biden's looking at, and the Senate and the House are sympathetic towards. So I'm really looking at that infrastructure spend, which could accelerate the cost of construction. At exactly the same time, they're trying to figure out how do we create cheaper housing. I don't know how they do that. I don't think it's possible to do, and I don't see anything in the next few years which is going to drop those costs of construction. I think construction costs are going to continue to build, and I think that the ability to finance them will become harder as we get into next year.
Okay. Christopher Confetti is very small on my screen, so I'm sorry if I'm mispronouncing your last name, Christopher. He asked this question. Another economist is predicting growth up until about 2028, and then it will crash.
Mm-hmm.
Do you agree with that?
Well, again, 2028 is pretty great. And the economist that I know who talks about 2028 is retiring before 2028. So he can call that pretty safely, because no one will ever be able to come back and bite him on it. We can say that recessions happen. If you don't know anything else, and you want to know when the next recession is happening, you take where you're at and you count on your fingers. When you get to the end of your fingers, in those last 2 years is when the recession tends to happen. 82, 92, 2001, 2007 was a black swan, 2020. So that means 28 to 32 is very susceptible just from the normal business cycle for a downturn. On top of that, we have a lot of demographic weight where the incoming new workers are going to have a hard time replacing the workers that are leaving. And we're going to have the extra costs that are associated with Medicare and Medicaid. All of this brings us to really a storm that suggests that we should worry a little bit about that time frame. How deep it will be, I don't know. One of my favorite books when I was younger was The Great Depression of 1990, written by Dr. Ravi Batra. I think I got that right. We didn't have a Great Depression in 1990. And he had walked through all the reasons why it should be there. There's lots of things that can derail it. Better technology. If you see some technology jump offs like we did during the 1990s, if you see AI all of a sudden jump to a different level, if you see blockchain all of a sudden start changing the game, it could derail that prediction. So do I think that you need to be cautious about that time frame? Yes. I think we are susceptible for a deeper recession at the end of this decade. Yes. Does that mean it will happen? Maybe.
Good answer. And then the next question here is about gas prices. How long do you expect the increase in gas prices to last?
We know that they were already going up before all this happened. And so we expect that they will be more elevated than at the end of the year than they were at the start, just because of OPEC having greater weight and the fact that we have a lot of fracking companies that went out of business. So we have this short-term effect from what's happening in Texas. The bad news is it looks like it's going to be next week before we actually start to restart some of the refineries. And it can be up to a 2-week time frame for those to restart. And then it could be another week or two before they really start pumping out good product. So we're looking at 6 weeks right now before what came offline is back online in a reliable manner. And so we could see elevated prices for the entire spring here. And then you get to about April 15th, and that's when you get the summer gas price bump. So when we move from the winter gas price blend to the summer gas price blend, the summer gas price blend is about 15 cents more expensive than the summer price, than the winter price. And federal regulations require you to switch almost instantaneously. So that's why the highest price normally is in the late April anyways. And so I think that we're I think we're in for many weeks of strength in this market. It will depend. If we get lucky and they're able to start restarting stuff this week, it'll start moving stuff forward. But when you take that amount of production offline for the amount of time that it's going to be offline, it's not going to disappear very quickly. Think about this. Hurricane Katrina went through and took stuff offline. Most of that came back online a month later, not all of it. Think about how long prices stayed up. So Hurricane Katrina also destroyed some infrastructure. So you have to think about when did it come back to its new plateau, which was a month or two out.
Great. And Jim has a question here about some of the industries that are being affected by this pandemic and the resulting economy. His question goes like this: with restaurants that have not made it, and retail being affected by Amazon, and now the office rental space not being in demand as much anymore, and more people working from home, how does all of those factors affect the economy?
Yeah, well, it will create a lot of struggles in commercial real estate, that's for sure. I think the restaurants will come back pretty quickly. Restaurants come and go anyways, and I expect that they will come back relatively quickly, meaning a year, 2 years, 3 years, depending on the city you're in and how many restaurants disappear. All right. The staying at home bit is going to happen. And when we talk to CFOs and CEOs, what we're really looking at is those transactional jobs staying at home, and fewer transactional jobs altogether. So if you take a piece of paper and take it from one person to another person, those are the jobs that are going to be most problematic, and likely may not come back at the end of this recession. In fact, we told you that last year. So it's going to move us up the chain on the types of jobs people have to do to stay in a job. People are going to have to be more educated. They're going to have more training. Education doesn't mean having to go to school, but it does mean having to learn from someone something that is valuable to someone else. And that can be plumber, or it can be going and getting a PhD. So we're seeing that. What do I think is going to happen? I think commercial real estate is going to struggle. I think that there'll be opportunities in that, and that there'll be new types of spaces that people want. We know that what the CEOs want to get back to the office are those creative teams. They want those creative teams working together and blending together. And that's a different space than a lot of this commercial space looks like now, which is designed around transactions. So I think there's going to be some opportunities in that as well. So what does all that do? What it does is it takes money from this person who is doing commercial real estate to this person who has a server farm. And it's just going to move the money to different groups of people. I don't think the economy as a whole will be hurt by that.
Okay. And Matthew has a question here. How are you evaluating the effects of PPP and or rental assistance programs?
Oh, that's been really hard. So PPP kept people in jobs, and it's one of the reasons why the unemployment rate is lower than it would be, because people are being kept in jobs that aren't economical for them to be in using PPP. In fact, that's far better than unemployment benefits. It keeps the worker attached to the company and allows that company to come back faster when things reach the other side. So the PPP is really showing up in the fact that unemployment rate right now is actually lower than what we would have expected it to be before. So our employment numbers are a little bit higher than we expected they would be. And we can map that out because we know what the average worker makes, and we know how much PPP has been placed out there. All right. The rental assistance programs is, I talk to people who are on all sides of this game. And we know that the number of attempts to remove people from houses has gone up. We also know that a lot of money is flowing in to keep them there. Unfortunately, on that side, there's not enough good data yet to tell us how big of an effect that is. But what I am seeing is not a huge increase in number of people at homeless shelters. So they're either doubling up with another friend, or they're finding a way to stay in the house that they're at, or the apartment that they're at. And if they're doing that and they didn't have the income they had before, then it's because the government's stepping in with that support programs. So when I'm looking at it as the economy as a whole, all I can do right now is take that total dollar value and add it in to what's happening to the total economy. Well, in 6 months, 8 months from now, we'll be able to look back and have a much better idea what those did.
Great. And I'm pretty sure you had some good news for vacation rental owners.
Yeah.
And we probably have a lot of those watching right now. Yeah. Lynette asks if you can repeat what you said about Airbnbs.
Yeah, I think right now that's what we see as very, very hot this summer. We're already seeing lots of things along the lakeshore where we're seeing it tight. We see those filling faster than the hotels. So we see those filling before the hotels, because people can go to those and feel like they're not right next to somebody else. They're not using the same ventilation system as somebody who's in the next room. And so they feel safer. So we really see that as long as the regulations allow it, that there'll be a lot of pressure on that. And we're already seeing that in pre-rentals across the lakeshore here in West Michigan.
Great. And Paul asked a question, will we see foreclosure if the pandemic effects continue 3 years? And I'm assuming he means, will we see more foreclosures?
Yeah, the longer it goes, the more you'll see. So what we do know is the stimulus package that's in place basically gets us through September, meaning the one that I think will come out of Congress will get us through September. If we get to September and you still see lots of people can't go out to eat, you're still seeing people scared to do things, you see consumer confidence low, you see that savings level still high, then you know that people are not spending their money. And that's going to start, number one, it will say that I was wrong, and that you need to be thinking that what I'm talking about is now being spread out over a longer time frame. But number two, it will tell you that as we go into the fall, that you should start to see foreclosures start to rise. And I would expect that you'll see a few more foreclosures near the end of the summer anyways, because we're going to start to see some of these packages that are supporting people in houses, zombie houses, may start to break loose. But I think that there'll be enough in this package to allow those zombie houses to make it till fall.
Okay, thank you. And then Brian asked a question here. Any thoughts as to when housing inventory might start to increase? When will we see more inventory?
Well, it depends on where you're at. I don't think that there's the capacity to increase it right now. The construction costs are really high. The developers are trying to decide where to get in. That we're not seeing, at least across West Michigan, we're not seeing permit applications, which would suggest that it's going to take the pressure off of housing inventory. So the only question we have in existing inventory is, do baby boomers decide that they want to move into some of these new multifamily or some of these new condo units that are coming online and freeing up some of that space once they start to feel more secure that their retirement's not going to evaporate away because of the pandemic. So I don't see any good news on that front for the next 2 years here in West Michigan.
Okay, so we have a lot more questions here, and I don't know that we're going to get through all of them, but I would just say to our audience and our listeners, if you see questions in the Q&A panel that you absolutely want to hear answered, vote for them so they move up to the top, because I'm just kind of going in order here. And we
want to make sure we give people time to do some networking here at the end too. So.
I agree. So we'll probably do about 5 more minutes here of Q&A and then move to the networking. The next question in line here, Paul, is the Fed's announced that 3% inflation is now the target, not the ceiling. What would we expect them to do differently?
Well, we expect that they'll leave that short-term interest rate low longer, that they won't respond to the fact that Janet Yellen's taking $1 trillion out of the bank and moving it into liquidity. They won't start a taper program in the near future. And remember, that 3% target is because they're now looking at minority employment as opposed to overall employment, because they want to bring down that minority unemployment to help the social justice concerns. So all of that's going to mean that instead of seeing, remember, the Fed will get to decide how many of those basis points I was talking about end up in price and how much end up in interest rates. What this tells me is they'll let prices rise faster than they're going to let interest rates rise. And what that means is, for somebody like me who just refinanced, there's a good chance that my real interest rate, my interest rate minus the inflation rate, is going to be negative. So in effect, I'm actually making money by borrowing money. So it's going to be really good news for those who have been able to take advantage of these low interest rates at the beginning of the year.
Okay, and we have a question that jumped to the top here from John. He asked, do you have any investment ideas for the coming high inflation?
Oh.
But where should people be putting their money right now?
That's a great question, and I haven't spent a lot of time thinking about it. But you probably should go back and look at how people were behaving at the end of the 1970s, because how they were behaving at the end of the 1970s and because they had gotten used to 10 years of higher inflation. Here's what we do know. We know the vast majority of professionals in the finance industry have never experienced inflation. All right. Think about that. You're under 40 years old. You haven't seen inflation. You're under 50 years old. You barely have seen inflation. You saw it when you were a kid. You saw your parents dealing with inflation. But what we do know is that inflation favors the borrower and hurts the lender. So that bigger scope picture says, number one, I think the yield curve is going to start stretching out. So there's some plays that can be made on a stretched out yield curve. But I also think that favoring higher inflation versus higher interest rates means that it's really going to favor those who are able to take advantage of that borrowing side. So you need to look at industries that are thinking that way. So I've done that at about a 70,000 foot level, and I'm sure you all wanted to know exact places to go. I can't do that. I can say whatever I'm invested in, choose something else, because I'm not that good at that. I used to be, because I'd spend a lot of time doing it, but now I look at the overall economy.
Okay. All right. So I'm going to ask this question and then one more. So if you see something on here, vote for it so it moves up to the top. I'm going to take the top question here, which is from Brian, who asked, do we need additional stimulus if we're pulling out of the recession? And I think you can take that question several ways, but basically it is, do we need additional stimulus at this point?
I think that we may need some targeted stuff for the people in industries who can't go back to work. I have friends who work at venues where they do rigging and stage management. They haven't been able to work since last March, and they won't be able to work until the fall. So we need to think about that, not about the entire United States. And so I'm in favor of some very targeted things. That's not what we're seeing right now. And I think what we're seeing right now will actually lead to inflation more than it will speeding our economy out of this. All right. Okay. Understand that there are people who disagree with me. And Janet Yellen, who's a very smart lady, who has a lot of information at her fingertips, disagrees with me. So I want you to just know that.
Okay. And the last question here before we move to the networking. And this is from Ed. How do you see home buying movement to the lakeshore in West Michigan from the pressure for housing in Grand Rapids.
Yeah.
Do you see Lakeshore having greater growth than Grand Rapids?
Wow. I keep expecting it, and it keeps not happening. So we do know, particularly as you go down 96 as opposed to down 196, that there's a gap in price, and that gap shouldn't really exist because the commute is easy. It's not far. And it's that people don't think about going there, or that there's a bad rap. And so I keep expecting that will happen, and it hasn't happened yet. So I think that the pressure is there. I think it is primed to happen. And I think that the people who are selling it, the people who want it to happen, haven't done a good job of convincing the millennials in Kent County to do it. So I think it has potential. It hasn't happened yet, and we'll see.
All right. So I know I said that was the last question, but there is a quick one here, which is, Paul, where do you get your information from? What news, periodicals, journals do you go to that maybe people watching and listening can go to as well?
I use a lot of primary sources, so I do a lot of going to the actual data, but places that I really like, places I really like are things like Bloomberg News. It is in the reliability piece, relatively centrist, very business oriented, little less political. I like to do that. I like to take something that's a little bit more left, whether it be the New York Times or whether it may be the written CNN, the online, the CNN and those sorts of things that are on TV are entertainment, in my opinion. I should say in my opinion, so I don't get in trouble. All right. And on the other side, I like the Wall Street Journal and those types of things to sort of balance that center right, center left sort of thought process. And then I stretch out and I look at the far left and the far right media just to get a sense as to where some of those political pressures will be, so that we can ask, what's the probability of that political pressure happening? I don't use it to find facts. I use it to find what's the pressure going to be. So you're pretty safe with any of the mainstream networks. You're pretty safe with Wall Street Journal, New York Times. Realize they're on the opposite side of that center line. But I can tell you the one that I wake up to in the morning and I read first is Bloomberg.
All right, great. And we'll end on that note. Paul, thanks so much for doing this presentation. It's the first presentation of our virtual annual conference. And we always love seeing you in person, but I think this went pretty well this year. And hopefully we can see you in person next year.
Excellent. Thank you so much.
And there's a lot of great comments here, a lot of people who really appreciated your presentation. So thank you.